For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Yes, we are managing your financial future. Welcome back to the program. Johnny Dean, your podcast host. Thanks for joining us, every single one of you. And by the feedback that we're getting, there are a lot more of you than there were even a year ago. So thank you to all the new listeners that we've gotten and the emails that we get. And we're appreciative of everything that you folks, all the feedback, good and bad. Have you gotten any bad feedback, Professor Plum?
I have not, but maybe my people screen that off.
Well,
no, I'm kidding. I don't have people.
yeah, people is you.
Yeah.
And people is me. I have not really gotten anything negative, but I'm sure there are people out there who, wow, what are you talking about? But boy, we got something today. I'll tell you what. Professor Plum is a certified financial planner professional, CFP, registered trademark, et cetera, et cetera. I'm trying to do this.
Registered trademark.
Put the little R with the circle around it after your title.
CFP.
Yeah, this is really something. I want to talk about this. We've been discussing the last couple of weeks, running out of money and people having fears. And last week we talked a lot about withdrawal methods. What's your withdrawal method and why it's a fact. I'm going to say it's a fact that accumulation strategies and distribution strategies are two different skills. In fact, opposites.
You can't just continue the same strategy and reverse the flow of money.
No, you cannot.
You can. But you do it at your own peril.
You do, and it may turn out great. I mean, I could throw $5,000 on the number 36 at Las Vegas roulette. I've never played it. Is that a number? Okay, I don't know, but I mean, that may turn in wonderful, but probably not. And I don't think people should gamble, and I think most people don't want to gamble. You found this. This was
well. Last week I alluded to some number from a study.
Yes,
I couldn't remember where the study was from. I thought it was, and I took it back, but it actually was from that company, Northwest Mutual, about what it takes to feel comfortable in retirement.
Yeah.
I threw out a dollar amount, and you kind of looked at me like, "What are you talking about?"
Well,
so later in the day, I found that study, not the study. I found an article on the study. And said, this is where that number that I referenced in last week's podcast came from.
That's it. You found the article and you sent it to me. Now, the purpose of the article itself is kind of irrelevant. It was supposed to show that, gosh, Americans, they need all this extra money. We're not saving enough, and it's cost so much to live. And it was supposed to...
The idea was the average American needs almost $1.5 million to retire comfortably, to feel comfortable about their retirement.
But here's...
Problem is, we have no idea how they came up with that number.
They didn't. Okay, so Northwestern Mutual did this study, and it was reported on by a couple of media outlets. But if you go to this study, they surveyed 2,700 people. Now, that is not a representative sample.
That's a fairly small sample.
It is a very small sample, but they didn't really care. The point was that they asked these people I guess the question was, what do you believe you need in order to retire comfortably? What's your number? Was it the old commercial? What's your retirement number?
Your retirement number, yes.
Yeah. I don't know how this question was posed. I don't know who these people are. I don't know how old they are. They never said any of this stuff. But they said that...
I'm presuming, because they did talk later about Gen Z and Ys and millennials thinking they needed 1.6. So I'm guessing this is more Gen X and boomers.
And maybe it's an average of what they said, but the number they came up with was that these 2,700 people online said that, I guess on average, response was they need $1.46 million in order, I guess,
to retire comfortably.
To retire comfortably. And they say it's the highest level on record. Well, I don't think there is a record anywhere. But
looking at the article, it seems to allude to the fact that they've done this survey over multiple years, because they talked about the number that came out in 2022 or 2023. And it's gone up quite a bit since 2023.
Yeah.
They talked about the number in 2020.
Which was like 951,000.
So
where did that number come from?
50% higher than it was 4 years ago.
Which is crazy.
So to me, it says that they do this study ongoing. But
I've seen this. I went back 4, 6, 7 years, something like that.
So the number that people believe they need to have to retire comfortably is going up. Oh, there's a shock. I mean, it costs more to live today than it did 5 years ago.
Perhaps, but they're asking a different set of 2,000 people here, 2,000 people there. I don't want to dwell too much on that because the point isn't necessarily to show you.
Well, the idea is how did they come up with the number? How did the people that they asked come up? I mean, some of them said, "Well, I need 1.5." Some people said, "I need 1.2."
No,
Where'd
I
they
need
come
$1
up with the
million,
number?
maybe $1 million. I don't know, $2 million, something like that. I mean,
how much do you need to retire comfortably?
They did not ask these are not the same people. They didn't ask the same people every single year.
No, probably not.
They aren't doing that. And here's the other thing that I'm sure that these people who said 1.46 million, whatever, I'm sure they did not do the math and say, well, I've spent the last 6 weeks going over the numbers or the last, 2 days, whatever. And the number that I came up with based on all my calculations is I need 1.46 million. I can almost guarantee you they did not do that.
They're picking a number that they feel sounds like a good number to have at retirement.
And that number is going to be based on their mood that day. Okay?
Yeah. And did they just get done paying their property tax?
I'm telling you.
I need a lot more money than I thought I did.
You cannot rely on these surveys. But what this is supposed to do is supposed to scare people into saying, "Oh gosh."
Well, they equate that, then they show the average savings for age 60, 65 and things, and saying Americans are woefully short in their retirement savings compared to what they say they need for retirement. And that isn't I mean, it's a very broad statement, and it's probably not wrong.
No.
But are you as short as that? I mean, because the average saving for the average 65-year-old is probably in the $250,000 to $400,000 range.
Well, it was. And here's the thing. And they did.
So that's a little short.
Well, it is short. Now, the point of this podcast and this topic is not to scare people and say, gosh, everybody needs $1.5 million. No. I want to point out that these numbers that were thrown out by whoever these survey respondents were, no clue their age, no clue their income, no clue their current circumstances, no idea what their mood was that day. But these numbers are random numbers thrown out by people, I believe, who haven't even bothered to look.
Right.
It just seemed like a cool number to throw out to them that day. The point is going to be that you need somebody to take a look at this. Now, they did throw some math out there. I don't have it in front of me. And this was a good chart that they showed. They showed, well, how do you amass $1.46 million if you really need that? How do you amass that? Well, if you start at age 20, I'm trusting their math. They said something like you need to put away $380 a month. Okay. To get to age 65, I think it was, right? You need to put away, assuming they said a 7%, it was a 7% daily average. So put in 7%.
Annual average.
Yeah.
Not daily. You're not getting 7% a day.
Well, they said daily. I know what they meant. 7%
compounded. Across
the board compounded, correct. So, okay. If you start at age 30, it was something like $1,000 a month. I'm getting these wrong. If you're 40, by the time if you start at age 50, you need to save like $5,400 a month to get there. So the obvious thing is, and they are correct, start early. Not everybody starts early. I get that. And that may have contributed to the number that they're fearing that they need to amass to get there. Did I do the math? Is that about right?
$4,600 a month if you start at 50.
Yeah.
And you want $1.46 million by the time you're 65.
Okay. All right.
That's assuming a 7% average annual rate of return.
Right. But that's a lot. If you start at 20, you only need to put away about $380 a month. So there's a big difference, and that's the magic of compounding. So, Professor Plum, what gets my goat about this thing is that these are random numbers being thrown out by people. And then news organizations, of course, jump on this because they want to try to scare you. And you should be concerned.
And you should take some action. As we've talked about, the hardest thing about creating a net worth is starting and getting it going. I was speaking with somebody today. They were talking about should they continue to increase their 401k contribution. We've been increasing it 1% a quarter. Mm-hmm. And they're saying, well, I want to pay off my house and I want to pay off my car. And so do I stop the auto increase of 1%? I said, have you even noticed the difference in your paycheck when you do the 1%? No.
Well, then
keep doing it until you notice it. And because you're going to pay the $100 extra a month towards your car and other things anyway. And so we talked about whether she should pay off the car, whether she should pay off the mortgage, whether she should pay off, put more over here, put more over there. And it has a lot to do with the interest rates and attitude towards debt.
Well, what's your?
But it was a matter of don't stop saving for retirement.
Well, no, okay, and I think people know that. We're not giving them anything new. What are your thoughts on this whole idea that people believe, just random people believe, that they need on average they said about 1.46 million. I mean, as a financial planner, how would you look at that number? What would you say to
I'd
that?
back into it and say, okay, with 1.46 million, that's going to support roughly $60,000 a year of distributions based on the tried, true, and wonderful 4% guideline, not rule, guideline.
Sarcasm alert, yeah.
But no, I mean, we can use that for a high-level planning concept.
Okay, all right. So that gives you about $60,000 a year.
And at 65, maybe, married couple, one has a Social Security of $2,000, one has a Social Security of $2,500. So they got $4,500. What's that? $54,000 a year. So that tells me that this comfortable level of retirement is $115,000 $115,000 a year of gross income.
And anything less than that, they believe is not comfortable for them.
Well, and that is so regional too, because in some places, in Los Angeles, San Francisco, or New York City, that ain't going to cut it.
No,
that's just not going to do it. But you go out to Fredericksburg, Texas, and you could probably live like a king there for $110,000.
I've never been to Fredericksburg, Texas, so honestly, I don't know. But
you have an open invitation, though. I know you do.
I have an open invitation. All right. Well, if I know somebody there, maybe I will. Yeah, you're correct. So this number right off the bat is bogus. What I want to focus on, Professor Plum, is that, and you just said it yourself, is that everyone's situation is different. See, everyone across the country could be looking at this number, this 1.46 million that they read on an article, right?
Right.
And they say, "Oh my gosh, okay, well, I'm 50. I've got $300,000 in my 401k, and maybe I've got I guess I'm so short. I'll never be able to retire. This is scary, and it doesn't matter where they live, quite honestly. I want to sort of allay people's fears somewhat, because, Professor, you have seen people over the years that can live well below their mean. They 1.46 million would be way more than they could spend. And you've also seen
I've met people on both sides of that.
That's
equation.
what I'm saying. And you've seen people who say, 1.46 million, it might last me 6 years.
Yeah, I mean, they're looking at $10,000 a month retirement. Not.
Well, that's it.
It's like, oh my gosh, how could we ever spend that much money? So yes, I've met people on both sides of that equation.
Right. So I want people to, if you've read that or you've heard these numbers, to put it aside. I mean, it may mean absolutely nothing to you, because everybody's situation is different. Now,
and even if you do need that, proverbial $110,000 that we just talked about a few minutes ago
per year,
per year for retirement, how much you need to have in your investment nest egg depends on what we've talked about in the last couple of weeks. What's your foundation? How much Social Security do you have? Mm-hmm. How much pension do you have? How much other income do you have that has nothing to do with your investment portfolio? And two people that need the same amount of money, let's just take two people that live across the street from each other. They both need this $110,000 a year. One of them has a pension of $5,000 a month, and the one across the street doesn't have any pensions. But they both have Social Security. Well, the one that has the pension doesn't need as big of a nest egg because they've got that guaranteed income. Mm-hmm. So to say that person needs a $1.5 million, they're going to be really well off in this hypothetical example compared to the person across the street with the same $1.46 million. So
let's say you took one of these survey respondents who said, yeah, I need 1.46 million. That sounds about right. But they've never done the math. They've never done anything. And they sat down with you, and what would you say to them? You say, well, wait, let's find out. What's the first thing you would do?
What are your spending needs in retirement? What do you think you're going to need to be spending? Or you're retired now. What are you spending in retirement? How much do you need every month?
Yeah, let's say I'm 60 years old, so I'm either retired or I'm really close.
Okay. And then how much do you have coming in, or will you have coming in from other sources? You've got, a 400-unit apartment complex that's paying off pretty quick. So you've got your Social Security. You do or don't have pensions. Let's look at all these other income sources. Now let's find the bogey, the shortfall.
Okay, let's say I need to spend $100,000 a year. I'm just throwing a number out. And I have, a couple of Social Securities and maybe a pension. And between those, it adds up to about $70,000 a year.
So
I don't know. Guaranteed.
By rough numbers, when you retire, you're going to need about $750,000.
And you can't. So
using the 4% guideline.
So I am 20. In my example, I'm 25,000. What did I say? 70,000. $30,000 short.
Right.
I have guaranteed 70. I need 100, just based on my numbers
gross
right
income.
now.
Now we do have to understand what taxes are going to do to it there.
But just to start, so I'm 30,000 short. So you've done the math in reverse
quickly,
and you've said, okay, well, in order to generate $30,000 a year, the shortfall from my portfolio needs to be roughly
$750,000 at a 4% distribution. That's roughly $30,000 a year.
That's not $1.46 million. Now that's a lot of money, but it's not $1.46 million.
No. Obviously, if you have the $1.46 million and you're 60 years old and you're saying I need that 1.46, but I only need $30,000 a year, I'm going to say, why are you still working? You've got it covered. But I've seen that happen both sides, where people haven't done the math. They don't know what they're doing. Yeah. They've never actually looked into it. They've read the articles. It used to be, if you have $1 million, you can retire. You've got this number in your mind, but you don't know how to equate that to, the lump sum number of X equates to how much per month.
Yeah.
And how much per month do I actually need? And people haven't gone through the exercise of doing that. And so it's a matter of, let's find out what you need and how you're going to go about doing it so that we can tell. I've seen it where people say, oh, I can retire on $1 million. And they go through their expenses and their incomes and it's like, nope, you're not going to cut it. Something's going to have to change because you're spending significally more than what you can do.
Even if they're bucketized.
Bucketization doesn't cure overspending.
Right. Okay, so you've just decided.
People are saying, I was talking to somebody the other last week, and they say, I need about $100,000 a year. The pensions, not pensions, but Social Security and such are going to be X, and we need maybe $7,000-8,000 a month gross, and their pensions were going to be, or pensions, their Social Security was going to be $5,000 combined between the two of them. So they only needed more for the first couple of years because Social Security wasn't going to kick in right away, but they only needed like $2,000 or $3,000 from their portfolio based on their numbers, and they had $3 million.
Now, you've just decided that I need a $750,000 portfolio based on the fact that I told you I need $100,000 a year, and I've got, between pensions and Social Security, I've got $70,000 coming in right now. That's what I'm spending. Now, there will be more questions that you're going to ask me, though, Professor Plum, because at the moment we need a $750,000 portfolio. But you're probably going to ask me, well, are you paying a mortgage right now? And when is that mortgage going?
Well, we were just doing it in a very quick overview, broad base.
But there's a deeper layer to it.
To get to the real number, we need to know what you're spending actually, and how much inflation do we need to add. Somebody who has a mortgage that's going to carry a mortgage for the next 20, 30 years into their retirement, and it's a fixed mortgage, that isn't affected by inflation. So
it's actually helpful.
So maybe if your mortgage is 30% of your overall need, 30% of your expenses do not increase. Now, your property taxes do, but that's a different issue. So we don't have to apply a huge COLA on the entire need, but we do have to take into consideration that other expenses are going to go up over time. Then, or maybe your mortgage is only going to last for another 3 or 4 years, 5 years, and then it cuts off. And then now you've just picked up a bunch, or you've lost a bunch of expenses. You don't need as much as you needed before.
And am I going to need,
or at that point, are you buying a vacation house where the other grandkids live? Because you've got a place where one set of grandkids live and the other ones live across the country. So maybe you're going to carry more, we're going to have bigger expenses there. So all of this goes into play. What are you spending? What are we looking at? How are you going to do this? What's going to happen?
And am I going to need, I need $100,000 at 65. Do you really think when I'm 85, I'm going to still need $100,000 plus inflation, which maybe at that point is, who knows, $160,000? I don't know. I mean, do these things play a role when you're trying to determine how much somebody needs?
It does. We typically err on using more income.
Sure, I understand.
They think they might need, and using more inflation. Okay. It's really easy to explain why you end up with more money than you did, because your spending went down.
Yes.
Rather than to anticipate spending going down and it not going down.
If you said I needed $750,000 based on this imaginary scenario that I just gave you, this hypothetical scenario, and you said, well, 750, and you eyeballed it, and that's about right. Gives me 100,000 a year, 4%, bucketize, and all that stuff. If I said to you, I've only got 500,000. I mean, I'm short. Is there a way that you can I mean, what can we do to make this work?
Well, there's only a couple things you can do to make it work. One is take more risk, try to earn a higher rate of return. Not always the easiest thing in the world to do.
Yeah.
The other area is work longer. If you have that option, you don't always have that option. The only other thing after that is spend less.
Spend less. Yeah.
Or die. Hate to say it.
Well, that's not
a lot.
That's not advice.
No, that's not a strategy that we want to plan for.
No. But
we all are going to at some point.
Yeah.
But no, or just understand that if you continue spending the rate you're going to do,
right,
it probably will not last until you're 90. You're going to run out of money from the investment side. You're going to go from spending that $100,000 a year to only having the $70,000 a year when you're 80, 85, or some number out there.
But see, here's what I've done.
Some people will say, okay.
Here's what I've done with this, though, Professor Plum, is I haven't just pulled a $1.46 million number right out of the air. I haven't pulled a $2 million number out of the air. What I've done is I've created an imaginary hypothetical scenario, and I've gone to you as my financial advisor, and I said, look, I thought I needed $1.4 million. You said I need $750,000. I mean, that's
a big difference.
That's about half.
Right, and if you're looking at, you've got your $500,000 that you said you had.
Yeah.
Okay, 750's more. It's going to be tight, but 1.4 million is a lot more,
right,
and it's not going to work. And you're going to be defeated before you even get to retirement.
Right.
And unfortunately, a lot of times when people feel defeated, they're like, "Well, why?
What's the point?
Why am I saving anyway? I'm just going to go buy a new car.
I'm going to enjoy life.
I'm going to buy that new Tesla at $120,000."
This is why you have to go in and talk to a financial advisor, and I would suggest you do so with Professor Plum because of your experience. And if you just came out of that number, you know this stuff backwards and forwards,
right? But that was a very
it was
generic.
Of course. No, I understand
system there.
But now I thought I needed $1.5 million, and you said I need half that amount, and now I'm feeling better because not only is the number lower, but a guy like you, an advisor who's asked me the right questions, has said you don't really need that. Now this 1.4.
Well, and I've seen it also happen where people are looking at, I want to retire, and they're thinking, I've got 500. They're telling me I need 1.46. Let's just call it 1.5 million. I'm never going to get there. But then you go and do the numbers and you find out, well, it's only 750. Well, that's only a couple more years down the line.
I'm working another 5 years.
I can do this. I don't feel as bad about my situation, and I'm more likely to do something positive towards it.
Yes.
The emotional impact of understanding how you're dealing with your own retirement is very strong. I mean, it can really defeat us. I mean, it can just say, "Oh, crumb, man, I'm never going to get there," or it can be like, I'm not as bad. I'm almost there. I just need a little bit more. I can work that extra 2 years. I will. If I'm looking at working another 15 or 20, I'm like, oh, I'm never going to do that. But if I could 2 more years, I could stick it out for 2 more years.
Right. Oh, and by the way, if I do need to cut back on my spending, maybe I don't need 100. Maybe I can cut it down to 80 or 85.
I'll work it going forward.
I've got a couple of years yet to figure this out.
And I've talked to people about retirement, and I've said, okay, look at what you think you're going to spend in retirement and use that as your budget now. And then save everything above it.
Exactly.
Start living on your retirement budget now. Get used to it and see if it actually is a reasonable budget. Now, it's not a fair thing because you're still working and you don't have the time to do a lot of the things you want to do in retirement. Travel or see the grandkids, do whatever. I don't know what you want to do in retirement. But you get an idea of what it feels like.
This is why I get and why I wanted to devote this topic today to this podcast, because it really gets under my skin when they tell me this stuff and I read these things. Even the survey source didn't tell you anything that you needed to know. People are just pulling these numbers from somewhere, and they don't actually know what it's going to require. If they're not feeling good because they just paid, the 10% more at the grocery store, they paid $110 at the grocery store.
Or they just had, the washer and dryer went out and they got this big expense.
Exactly,
and
whatever.
Oh, man.
Right. So they just grab this number, but what they're not doing, in my opinion, is they're not seeing a professional that'll say, hey, 1.46, I mean, yeah, great, but you don't need that. That's not your baseline number. Based on what you're telling me, maybe you only need half of that. And it's not that far away.
You need,
at
least you know your number.
Maybe it is
and
that number.
You know whether it's reasonable or not.
Oh, yeah.
And maybe you need an awakening, that little proverbial slap across the face to wake you up and say, you are not being reasonable.
Or here's the optimistic side of that. You see somebody, you say, and you've done this, where you say, you know what? Based on the numbers, you could retire now if you wanted.
The person I talked about earlier in the podcast today, that's what I asked him. I go, you said you were going to work another 2 years because you felt like you had to.
Right.
Why are you working another 2 years? They had oversaved.
Yes.
And they don't have to be aggressive. They can actually be fairly conservative in their assumptions and their investment strategies to be able to maintain and grow and still leave a very nice legacy, down the line.
It's not always bad news. I mean, this whole survey is supposed to get you upset, and it's supposed to think I don't have anywhere near that.
It's supposed to motivate you to save more money.
Well, and eventually do business with these companies. And I mean, okay, I get all that, but let's back this up. I wanted you to just.
You really should do your own individual planning because you are different than every one of those 2,700 people they interviewed.
Exactly.
You're different. Your situation is different than anybody else. You have a different Social Security benefit. You have a different married, maybe you're single or married, had a household, this, that, and the other.
Yeah.
You have a different portfolio. You have a different portfolio makeup, IRA, Roth IRA, personal money. You have different
risk
pension or not pension, different attitudes, different emotions.
Yeah.
You are different than somebody across the street who may need similar amounts of money overall, but has a different structure and a different risk tolerance. And they're inheriting $10 million in 10 years, and so they don't have to worry about saving it.
That's another situation.
Run into that too.
Hey, that's another situation. Exactly.
People talk about, we need 30 years of retirement. I've seen people that say, I don't need 30 years of retirement. My grandfather is 92 years old. Yeah. He's worth $10 million. He's not going to spend it all by the time he and there's only 2 beneficiaries. So I know I'm going to be getting $1 million or 2 or something or more.
Right.
So I just need.
I need enough to get
10 years or so.
Yeah, there you go.
Or and you can, unfortunately, look at it like that at times.
At times, I'm not sure you want to count on it.
Some people can count on it. Some people can't.
Right. But again, what does this all come back to? Talk to somebody who knows.
Talk about your situation.
Talk to somebody who's got the calculator and somebody who knows which questions to ask. Not the person who goes online and says, how much do you think you need in order to retire comfortably?
$1.5 million sounds like a really nice number.
Yeah. And 2.5 sounds better too. I like that.
Yeah, but I don't want to be greedy.
No, but.
So we'll go with 1.5.
Yeah, but I like to blow my money, and I don't know, I like to spend it a lot. And I don't have a withdrawal method, and I like to do systematic withdrawal.
I do it all wrong.
Yeah, exactly. As we said last week, I mean, you could have $1.5 million, and that is your retirement number. But if you have the wrong withdrawal strategy, hey, forget it, man. You didn't have enough.
Depending upon what happens in the first 10 years of retirement, yeah.
That's why we do the bucket strategy, which I should remind you. I told you last week, and this guide that we have online, you go to luciacap.com, LUCIACAP.com. You know that. Go to the search bar and just type in buckets or bucket strategy. You'll see the bucket strategy guide. It'll explain all about how the bucket strategy works, and you can read it. It's free, of course. Download it. Read it at your leisure. We've got others. We've got an estate planning guide. We've got a
50 questions about Social Security.
50 questions. Yes, right. The Social Security decision kit, all that stuff. Available free there at luciacap.com. And I just want you to know, take this with you, this advice, that don't go online and see these headlines and say, oh, people said 5 years ago they needed 900,000. Now they need 1.5 million. That number is based on...
I'll never be able to keep up.
It is based on nothing.
It's not based on you.
No, it is not.
So let's find out what your situation calls for.
Exactly. All right. Thank you, Professor Plum. I want to, next week, now I said this last week, you've got a talk going on to a local Rotary Club, actually, about charitable giving and qualified.
QCDs and RMDs.
Yeah. I'd like to, if I can, on the next show or after that, have you encapsulate that. Why don't you give your speech, because the speech is
it's not like I have it scripted.
No, I know, and that's the thing. I got to keep you in line here. But I would like to talk with you about that. That's some important stuff, and I know you're going to get some Q&A from some of these people. So
I hope.
We may be able to have some feedback from them, and I'd like you to talk about that, because estate planning, we just mentioned we have that guide. That's part of the estate planning, and estate planning goes with your
it goes with all
financial
your planning.
plan. Yeah, it's all integrated.
It's a part of your overall planning. And one of the things with charitable giving, a lot of people focus on the charitable giving during their lifetime, but they don't. Charitable giving doesn't necessarily stop when you do, because you may want to be giving something away of your assets when you die. And unfortunately, we see it done very inefficiently from a tax standpoint.
Well, I've teased a future program, so let's hope I do it. Let's hope we do it.
Hope we remember a week from now to do
it.
We
will remember to do it, but I just I've got to do it.
Write a note.
So.
Come on.
No, I'll do it.
And we're getting to the age where notes are important as long as we can find where we put those notes.
That's right. Sticky notes everywhere. I know. I'm not quite there yet, but I should be. Professor, thank you. I should remind you, too, if you want to talk to an advisor, please do. Please talk. Just find out if you're on track. That's all you got to do. It's a quick. I mean, you could do this maybe in a 30-minute meeting. I don't know, Professor Plum, or
depends on how complicated the individual is.
Well, that's true, but take the 30 minutes or whatever it is, and just find out. If you don't know what your retirement quote unquote number is, and find out if you're getting close to it. And once you do, if you are at that number, how do you make sure that amount of money lasts you for the rest of your life? Because honestly, when it comes down to it, you just don't want to run out of money before you run out of time, and a lot of people will do so.
And a lot of people worry so when they don't have to.
Exactly.
And why worry when it's not? Worry just takes away. It's not a positive issue. So let's take away the worry where we can.
That's right. Go to give them a call. You can 800-644-1150, 800-644-1150, or go to luciacap.com. You can converse with the folks there and say, hey, I'd like to set something up. And people do this all the time. We do this all the time for people. You should consider doing that, too, if you haven't done so already. I know many of our listeners have, which is, of course, a wonderful thing. Don't forget to subscribe to this podcast at Apple Podcasts, yes, and Spotify. You can do either place. Listen to every single episode. Do not miss that. It'll be downloaded right to your device. Thanks again, Professor Plum.
I don't know why apple pie just jumped into my mind when you said that. That sounds better, actually.
All right, well, we'll go out for a second lunch. How's that? Just you and me. For Professor Rick Plum, certified financial planner professional, I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thanks for listening. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.